Hi, everyone. Good afternoon, all. We would like to welcome you to our second conference call with Fund Selectors. It's a great honor to the RankiaPro team to continue organizing these conference calls, and we thank our three wonderful speakers for agreeing to participate in today's call. For this call, the topic to be discussed is sustainable investing, and more particularly, the growing importance of ESG factors in fund selection. We are thrilled to have with us today three investment professionals whose vast experience in the asset management industry, especially within the sustainable investing, will certainly provide for a very insightful conversation. On that note, I would like to welcome Susanne Bolin Gärtner, Anders Bertramsen, and Arnaud Bergeot, our three guests for today. Our three guests are presenting markets that are at the forefront of sustainable investing, with Susanne and Anders representing the Nordic markets and Arnaud the French market. So when it comes to looking at the evolution of ESG investing in Europe and how we can expect the asset management industry to continue to progress in the integration of sustainable criteria, we know that we have three of the best here with us today to discuss this matter. So that being said, let's briefly introduce them, because I believe that their backgrounds and their profile is just truly so interesting. So Susanne is head of manager and fund selection at Danske Bank as per January 2020. For the last 10 years, she held the position of head of fund selection and ESG external funds at Folksam. She delivered a sustainable guided selection of funds ranked highly among peers together with her team. Prior to that, she held several senior positions within the banking and insurance sector. She is also the board chairman of SWISEF, an independent association that has sustainable investing as its main purpose, and she's also board member of the investment committee for a child cancer foundation. Susanne, if this wasn't already an excellent background, she's also in her spare time devoted to yoga and Pilates as an instructor. Anders has been head of external products at Nordea Asset Management since 2017. He joined the bank in 2010 when he first worked as a selection manager for the fixed income team, and then as head of fixed income within the external products team. Prior to that, he worked as a portfolio manager at Handelsbanken Asset Management, as well as at Lehners Pension before starting his career as a consultant at Kirstein. Arnaud, representing France with us today, joined ABN AMRO Investment Solutions Manager Research Team in February 2016 as an analyst on bond and convertible bond strategies. As of 2019, he has been covering US equities. Prior to joining AIS, Arnaud was an assistant manager and fund analyst at Bank Leonardo. He also held the position of analyst at FundQuest Advisors, where he covered a broad range of asset classes. So with this brief introduction, I'm sure I could say much more of all three of you. I would like to welcome you to our conference call. And now, with this being said, let's get the conversation started with a few icebreaker questions in our debate section. So first of all, as we know, conditions have changed within the fund selection as a result of COVID-19, making manager and fund research more challenging, especially the qualitative research part. And also, as we have noticed, and we know based on the industry that we work in, fund selection requires working closely with managers and clients. I'm sure all three of you could tell us stories about this. However, the last few months completely changed the way we conduct business, the way we execute meetings. And I would like to just get to know your insight on this. And what do you see as the biggest change in the role of a fund selector in the upcoming next 1 or 2 years? Do you see this trend going on? And maybe Susanne, you could start.
Well, of course, there's less traveling and physical meetings. So that was a drastic change actually from mid-March, as I was also myself traveling to Copenhagen every week, but that took an abrupt stop in mid-March. And as from now, I'm working every second week in the Swedish office, and my colleagues in Copenhagen have gone back to work from home. So I think we will not have that many physical meetings going forward, but then we have new ways of actually meeting. And I think also these kind of digital seminars are quite exciting because it's very efficient, and you join from all over the world in an easy way. So I think it's coming to stay, but maybe we will get a balance going forward.
Yes. And do you think this you can efficiently continue working if this trend goes on for another year?
Yes, I definitely think so. But then I think for myself and my team, we need, like a kickoff in for the term, so to speak. If you have like in school, like autumn, now we have to sort of kick off. The worst part is if you just stay on going on from home, it's sort of you tend maybe not to be so proactive. So I think you need these kick starts to keep you active, I guess.
And Arnaud, how are things in Paris, in France? Is working from home and not being able to connect with managers and clients easily an issue?
Yeah, it's quite complicated, and we learn a lot using new tools at our dispositions, like Teams or Zoom or every webinar that allow us to meet also managers, but also our clients. I think the big change, yes, is we will use more and more this kind of video conference call that can be very helpful for introduction and monitoring. But to answer to the first question with Susanne, I think it's also important to go on site and meet the investment team in person, because we only during a video call, you can't really feel the work atmosphere, and we cannot see how people interact with each other. It's really important to go on site, but for sure it will enable us to really to focus on our best ideas when we will go on site. And unfortunately for us, it will take some times. And for the clients, I'm based in Paris, but some of my colleagues are based in Amsterdam. We will use more often also the conference call system.
Anders, for you, was this a big challenge to adapt to this new normal?
It is still a big challenge, and I'm completely with Arnaud on that. Existing managers, that's all fine. You know them, so you know what's going on. So the monitoring side is reasonably easy. And interacting with your own team, you know these guys, and you're gonna have some social interactions also, even electronically. But meeting new managers or deciding on managers that you want to allocate capital to, you have to meet them on site to get this close connection. If you're establishing like a white labeling partnership, which is hopefully for maybe even a decade plus, and we're talking maybe €1 billion, you want to see their office, you want to see their interaction, you want to get the genuine comfort that you do not get, whether that's video conferencing or phone calls. So
Yes.
I hate this. I'm sick and tired of it.
Thank you for your honest feedback. Continuing our little icebreaker debate section, majority of the asset managers, as we know, are shifting towards a more sustainable approach. So if we continue on this road, and I certainly believe we will, ESG might become the new normal. So when it comes to ESG investing, a main concern among the investment community is that the lack of standardization across the industry when it comes to ESG integration in the investment and reporting process, because it's really hard to see what a couple of managers are exactly meaning by ESG and meaning by sustainable. So how do you see this evolving, Anders?
Yeah, so I definitely believe it will continue to evolve, and probably down the line it will be the standard to some extent. I don't think there might be some kind of standardization ultimately, but I think it's actually beautiful for guys like us that there's a lot of differentiation, because that means that we have a job to do. But I also believe that you cannot take something as complex as ESG and turn it into one magic score or one defining label, because I think just look at all the labels that you have in Europe. Some are even contradictory, so you can't get some of the labels because they are mutually exclusive. So even if the EU comes to some kind of harmonization and so forth, and even if they develop some kind of rating framework or what have you, the asset managers will figure out how to game it. So they will design the process so it fits the labeling. But I think at the end of the day, you still need to do the fundamental selection work and interview as many people within the investment team as possible to get a feel for whether this is actually genuine or these guys just sort of rigged the system. So there'll be plenty of work, and I don't think a standardization will make it super easy, to be frank.
Thank you so much. So now that we have this section done, I think this is the most interesting part for all of us to hear these three excellent professionals go into more detail about their take on ESG and their take on fund selection. So I would like to ask Susan to start with her take on ESG investments within fund selection. And again, thank you guys for your insights with the two first questions.
Okay, thank you. And you introduced me, so I'm still with Danske Bank here since January, and it's been an exciting start, I must say. As I started with a lot of traveling and now sort of commuting, not so much, but having daily talks with my team and so on. And so for Danske Bank, we are quite Nordic. So our offer in external managers, we both have white label funds, and we also have external funds complementing the internal funds. So in my old job, I only had external funds. So this is a new exciting story, because in my mind, the end clients, they want both. And here we also see differences in the different countries. So I think they can live side by side, but of course, might be a bit subjective to the external funds. We do serve the whole Danske Bank Wealth Management in the Nordics and also in Luxembourg. So right now, my team is based out of Copenhagen, but then I'm sort of the balance to that, based out of Stockholm. And of course, we have a global network of investment managers, both existing and then prospect funds. I think the prospect funds is actually the most exciting part, because when you screen in all different tools, you can find good managers, but the whole sport is actually to find the ones who are not in there. They might be good for different reasons, but they've fallen out of because something happened, or they are too young or something. So that's a really interesting part of the job, I would say. And of course, we structure this in different components to the end clients in the different offerings within the banking and private banking and so on. So my team is actually Nordic nowadays, in the right sense, as I'm in Sweden and the rest is in Denmark today. But going forward, hopefully we will also grow the team. We are quite a slim team today, like 4 people. And it's a big job, both to monitor all the funds and also to look out for new ones. And my main task is actually this harmonization of the Nordic fund offer, because we have quite different offers in the different countries, and for different reasons. Because in Sweden, if you don't offer a lot of external funds to the end clients, they will go to another provider, another bank. But well, maybe Anders, you can correct me if I'm wrong, but my sort of interpretation of the Danish market is that the end clients are quite happy with maybe 60-70% of in-house funds, so to speak. So yeah. Anyway, we are harmonizing this fund offer, but then also allowing local differences when needed. So for instance, in Finland, they are very interested in alternatives, and in the Swedish market, we need like liquid alternatives and so on. So there are different needs. And historically, maybe Denmark has been more fixed income focused. And also you have to turn back, sorry.
Yeah.
Single point in for external funds. There are so many ways in, because there's so many people within a bank who likes to have views on external funds, and as long as they are not onboarded on the platform, then it is sort of easier for both parties, the external funds and also for us, to have a single point in. So that's also something I'm working for. And of course, the stepping up on sustainability, where I'm looking at the whole fund offer, because I don't think the end client should have to choose sustainable funds. If you choose a bank or an insurance company, you should know that the whole offer is sustainable. Having said that, we can move to the next slide. And I have, well, brought two examples of sustainable funds, and I did this in a sense of having one the old-fashioned way and one more new approach, so to speak. So if we start with the NN Global Sustainable Equity Fund, it is, you might say, it's a little bit more forward-looking, because it's looking for tomorrow's winners, and looking for companies where they engage on ESG factors. And here we have like 40 or 50 stocks in this portfolio. So they do engage with all of these companies. And the investments include solution providers in energy transition, sustainable food, smart mobility, affordable health value chains. And it's also, they show that they have low carbon and waste footprint. So this is sort of an active fund, I would say, and they are doing quite well, looking in the peer group, so to speak. So the other fund, that was actually what I was talking about. So you can take the next slide. The other fund is C Worldwide Global Ethical Equity Fund. And this is quite interesting because that is how it all started a long time ago, when you were talking about ethical funds. And now you might say, why do we still have a fund like this? Well, this fund has evolved over time. So it all started when you sort of said, what did you want to exclude, like tobacco, gambling, alcohol, and such. And then just investing in the so-called good companies. But over the years, this fund has actually sort of evolved. So now it is totally engaging with all the companies that it holds. It's a concentrated portfolio of 25 to 30 companies. And there they have a very high level of knowledge of each investment, and they engage with the companies. So I could take like one example here. You have like Nestle. They have sort of engaged with this company since they've followed the company since 1990. So that's quite a long time. And during the years, they have had different issues to engage with the company. So for instance, on palm oil or rainforest deforestation and child labor and so on. So when you sort of combine this together, you might say that the ethics is actually, what does your own company stand for? What is the hygienic factor for you? And then next step is, how do you sort of be active and engage with the companies that you have in your portfolio? So these two funds sort of, I think, in a combination, they're quite interesting. So yeah, that's maybe what I actually had. Yeah. And you can
Okay.
also on the engagement side, you can do collective
Mhm.
engagement or individual, of course. Yeah.
Okay.
So I think I'll
Thank you.
stop there. Yeah.
Okay, thank you. I'm sure that when we enter the Q&A section, if any of the attendees have any questions to Susan regarding this, please feel free to put it in the chat box, and then we will read it up to you, Susan, in the end, and then you can go ahead and answer them in the end of our conference call all together with other questions. So, Anders, as I introduced him in the beginning of the conference call, he is the head of external products at Nordea, and now I will give the word to him to talk us about a bit of Nordea's view on ESG.
Yeah, thank you very much, Liliana. So like Liliana just said, my name is Arnaud Bertramsen. I'm head of external products within Nordea Asset Management. Now, apparently compared to Danske Bank, we're a slightly bigger team. Apparently, we're 24 people in total, but that is also due to the fact that so the three boxes to the left of your screen shows the asset class teams which conduct manager research and selection within the white labeling space, and then we do the fund research for third-party funds. And those are anchored within those three asset class teams. And we have three business individuals, and then we have two teams that I also oversee who conducts private credit fund of fund investing and private equity fund and fund investing. We're reasonably well diversified with regards to nationality and geography, as we're based in Copenhagen, Stockholm, Luxembourg, and Helsinki. Liliana, if you flip to the next slide.
Yeah.
So this is just a brief overview of my business, so to speak, and I really haven't gamed the presentation here because I have the numbers from end of March where our assets were taking a bit of a hit due to the COVID sell-off, and our performance was also taking a dip. So, but here you can see that we were at the trough. We were down at about 25 billion euros of assets under responsibility. We're not managing them, so I would say responsibility. They have gradually come back up again. So I believe we're in the 28 billion euro space right now. Similarly, on the right hand side, our performance has also come back as several of our credit managers got somewhat beaten up during March and have gradually been grinding that back, thankfully. But that just to give you an idea of the business that we're running, which is particularly dominated on the white labeling side and with a quite massive tilt towards the fixed income space. If you flip to the next slide, Liliana. Yeah, so, and apologies for these figures that I've included. They are somewhat tricky to read. We really started looking on the manager selection side. We really started looking into ESG about 4 years ago by sort of having a letter designation compared to how much ESG we fundamentally believe the asset manager was conducting within the specific product. It was a very subjective. It varied a lot from selection manager to selection manager, and there was no clear boundaries of there was no framework. So one of my team members, Diogo Honorio, a couple of years ago, with the inspiration of the UNPRI and their self-assessment model and their questionnaires that they put forward, we developed this framework that you see here, where we look into the policies, the investment procedures, the monitoring, exclusions, engagements, and so forth, where we basically send out a quite sizable questionnaire, get a lot of responses back, or get a comprehensive response back, and then we rate the managers on these individual subcomponents, which then ultimately forms some kind of the final score. But even in such kind of framework here, there is still subjectivity, and ultimately we also know that some asset managers are better at explaining what they do, some are less great. Some are really great at saying what they do, but not really good at giving the impression that they actually do it. So you need to accommodate somewhat for that. It might look better in, you know, on a piece of paper than it is in reality. So we will subjectively tone the scores up and down, and those scores are something that we discuss in what we have called a selection board, where the heads of the asset class teams, together with the selection managers, discuss the individual managers. And as many of these managers are managers we know, we have opinions about the different managers and where we believe they are within sort of their ESG journey, because they are truly at different places throughout. But at least this gives us a common framework, and also to measure developments, because some of our managers we've started with Mackay Shields, for instance, in 2006, and on ESG they've come a very, very, very long way, and I would take some credit for that. This is actually something that we have been pushing them for to improve, so we can also see the improvement within the managers over time. So it gives us some framework, so it's not completely random how we assess the managers across the different asset classes.
Oh, okay, great. I'm sure you will get more questions on this assessment process and developing it, and I'm sure it was a great work to put together so ahead of the market when ESG just started to be very, very popular, so to
No,
say.
appreciate it. So I've taken so if you flip to the next slide, I've taken the liberty of adding 2 slides or 2 products, and it's shamelessly, it's 2 Nordea products that are managed by managers within my business. It's both fixed income products, and the reason why it's fixed income products and not necessarily equity products, I think, is partly due to the fact that you have a lot more equity products that are ESG orientated compared to the fixed income side. I think the fixed income also as a manager side are behind compared to the equity products. You see a lot of sector or thematic products within the equity side. You haven't really seen them to the same extent on the fixed income side yet, at least. But about 2 years ago, we started considering, so we have Aegon on high yield and Mackay Shields on IG, and we started discussing with them that we needed something with a much stronger ESG profile, a combination of exclusions and integration. So not either or, but we wanted both things. And we wanted to ensure that it was still it was still capable of being a asset allocation building block for a asset allocator, and not ending up in some weird, 5% of the US IG universe is all that's left for being investable. So that was a quite big process that we spent a lot of time on, and actively engaging with both Mackay Shields and Aegon, which is on the next slide, where we've worked with them on building their own framework. So both Mackay Shields and Aegon uses their own framework to assess the credits of the company from an ESG perspective, and they use third-party providers, and that's fine as input. I don't have any issue with that, as long as they don't use it as a definitive score and what can be investable and not. And another issue that was quite important for us was that they didn't just do the traditional model portfolio and then would weave out anything that wasn't sort of good enough from an ESG perspective, because that's not truly integrating anything. That's just an ESG overlay at the end. So we wanted to make sure that they had the ESG from pretty much the start. So you integrate the ESG step, or integrate the ESG analysis throughout the funnel that most managers usually portray. So it becomes a genuinely integrated part of the process, and not just something that these guys do at the end because, oh yeah, by the way, we can't invest in these energy companies anyway, so we have to remove them and then allocate 5% more to some utility companies to compensate for that. So that is some of the things that we work quite a bit with. I still think there's a lot of other fixed income managers that are coming online now and are putting some serious money behind their efforts, and I think that's great, because right now there are not that many options available. And you have seen some where probably the salespeople were quicker than the investment teams to get a go-ahead for launching a product, and then it was literally all tied to either the MSCI score or Sustainalytics score. and that's not really ESG in my view. That's just a negative filter to some extent. Yeah, so I think that was sort of short and sweet, my two products, but pretty much more on a focus on how we actually assess ESG within every product that we monitor.
Yes, thank you. And I'm also sure that regarding this process, there might be some questions as well, as you guys seem pretty experts in the topic, and I can see that you have a critical view on this as well. So following with the presentation side, I would like to give the word to Arnaud from ABN AMRO, and again, and I did an introduction to him as well. So with that said, Arnaud, the word is yours. We're super interested in what you have to say and your different view maybe on ESG asset class.
Okay, yeah, thank you, Elena. Just if you flip back, because I will talk about the product later. Just the goal of the presentation is to talk about the future of ESG, and it's a very broad topic, and there is a lot of different ways to talk about it. And today I want to talk about it from a regulation point of view, as it will impact in the coming months the ESG fund landscape in Europe. I also want to highlight what, as a fund selector, do we need to do to be vigilant when we select an ESG fund. And as you know, almost all of asset managers included some ESG slide in their marketing presentations these days. And the number of funds marketing as integrating ESG criteria is quickly growing. Even if it's a positive development, it also raises the risk of greenwashing, and it makes it hard for professional investors to understand what exactly they are investing in. And I let you imagine how it's difficult for our clients to understand it. And to tackle this ESG issue, the European Union has launched the European Union Sustainable Disclosure Regulation Project with the aim of issuing a regulation applicable at the European Union level. The goal of the different regulations, because a lot of local market regulators also work on this topic, is to harmonize the ESG disclosure standards for different types of products and different types of end investor in order to fight greenwashing. The goal is for each asset manager need to make sure that they have the necessary capacity and knowledge to effectively integrate sustainability risks. It also has to make sure that the knowledge is present at all required levels, top management, investment, marketing, compliance, and risk management in order to align ESG interests of manager and stakeholders. The regulator will expect that managers provide a clear information when reporting on the achieved sustainable performance, how the sustainable goals and characteristics of the benchmark meets off of the products. Data suppliers can help on this. However, the regulator expects that each company understand how sustainability score of data provider are calculated, and they have to take into account the difference between the different data provider calculation methods. As analysts, our goal is also to understand how ESG analysts work and how they calculate their own score or use the data from third-party provider. We need to know which data provider they use. We can challenge them on the sub-criteria used and their weight that they have applied. And we need to understand if the ESG rating is absolute or relative. The regulation will reclassify products and will create a real distinction between financial products with a sustainable investment objective called the sustainable product, and it will consider the impact and thematic products. Financial products with a sustainable characteristic called ESG products, best in class, best in universe, etc. And the financial products that are not promoted as sustainable, so the other products. To conclude on the new regulation, a lot of amendments are still unclear, and a lot of managers indicate that the level of sustainable legal trajectory are partly linked, but will not be effective at the same time. And the sustainable finance disclosure regulation will be published only at the end of this year for legal application in March 2021. So for us, the communication of non-financial terminology, SRI, ESG, sustainable, green, will be the name of the investment product, and it will be really written in the regulatory documents, KIDS, prospectus, and the brief mentioned in the marketing material. So it will be a little bit easier for us and for our clients. So I will go through the products. So As my partners of these panels, my firm, ABN AMRO Investment Solution, is a sub-advisory asset manager. We only select manager to delegate the portfolio management. We don't have any other capabilities. So in our analysis, we looked at the experience and the quality of investment and research people. We also analyze in detail the process of the idea generation, the research, as well as the portfolio construction and the risk and control integrations. All of these points have to be consistent with our study. And if we always looked at sustainable strategies since 2016, we are engaged in ESG analysis at the company and the strategy level in order to assess the sustainability of all of our investment strategies. So since 2017, we have launched a mandate with Parnassus, so it's the good slide, to manage a sustainable US equity strategy. Parnassus was established in 1984 by Gerald Dodson and has remained independent and employee-owned. As analysts, we believe that we can find the most talented investment people in independent boutiques, which are employee-owned. Equity have to be distributed among the entire investment team in order to align with the interest of their clients. We appreciate that the firm has only one investment philosophy, one process, and one team. And since its creation, ESG analysis has been incorporated in the investment process. Parnassus is a pioneer in the United States as far as ESG is concerned. The investment team is composed of seasoned investors, 18 investment professionals. Todd, the portfolio manager, is a portfolio manager since 2002, and the co-portfolio manager of the strategist is 2012. The team are also a dedicated ESG team of 3 people. The goal of this ESG analysis is to have a better understanding of the company in order to identify the risk and the opportunity. They start with the Russell 1000 index, and they apply some revenue criteria and exclude company from the universe. You can skip to the second slide if you can. So they exclude some company that with a significant revenue from manufacturing of alcohol, tobacco, weapons, and company that also use nuclear power, gambling, and fossil fuel. After that, they will reduce the universe to find the 400 stock that meet their investment criteria, and they will go through a full investment and ESG analysis. They have these 4 factors: the relevancy, does the products or service gain share? The second point is the moat, does the firm has enough sustainable long-term advantage, production costs, regulatory, strong brands, etc. Strong management team. The investment team look for quality management with a long-term focus. And the last one, the ESG criteria. The ESG analysis is run in parallel of this fundamental analysis, and they are focused on 5 areas. The environment, they look at energy and water usage, carbon footprint, etc. Community, relation with the stakeholder, public benefits, customer, product safety, workplace, diversity, inclusion, safety, and governance. The ESG team issue a report to the fundamental team with a pass or a fail. And after that, they will look for the full financial analysis with the project capital and free cash flow. So overall, it's a highly concentrated portfolio with a high active share, included between 80 and 95, and with a long-term investment horizon, 3 to 5 years, when the majority of US equity manager investment horizon are below 12 months. And the focus of the manager is really on the downside protection and volatility management. The role of the ESG team is to encourage positive change through shareholder engagement. As Parnassus is one of the largest sustainable boutiques in the US, with a long-term view, a lot of companies listen to them. They are concentrated on their engagement on company they hold, but they also take some initiative for new collaborative opportunities. They are part of a lot of ESG organizations, and even the head of research is a board member of the US Social Investment Forum. In terms of just just a quick one on the performance, the downside capture ratio has been constantly below 100, with an average of 80, and on the other side, the upside capture ratio has been around 90. So the strategy has really good downside protection, and is complementary with the US equity strategy, which is a little bit more aggressive. If you could slip to slide after, sorry.
Yes.
And the other strategy, no, and the other strategy that I want to talk is also a fixed income, like Anders, is the Condriam Sustainable Bond Emerging Markets. It's a complete asset class with a few choice in terms of strategy. So I think everybody knows Condriam was one of the pioneer in sustainable investing in Europe. They've launched their first SRI portfolio in 1996, and they have increased their commitment toward ESG. And they also, over the last years, continue to increase their resources and the dedicated resource toward engagement and proxy voting. So the emerging market team is part of the global fixed income business. It's 6 investment persons. Diliana, the head of the team, has a long investment experience in emerging markets. And the team works very closely with the ESG and investment and research team, especially with the analysts focused on ESG sovereign research. Condriam has established in 2009 for the developed market an ESG sovereign analysis, and they have expanded this analysis in 2016 with the all of country. Overall, 123 nations are analyzed from an ESG perspectives. Just if you could flip one slide after.
Mm-hmm. Of course.
They have a best in universe in screening with 4 pillars. In these 4 pillars, they have 23 sub-pillars which cover 75 themes. So the first one, human capital, it's labor, health, knowledge. They look at the budget, the health budget, medical infrastructure, etc. of each country. They look at the natural capital, the impact in terms of energy and climate change, etc. Social capital, demography, corruption, governance, and the economic capital, the foreign dependency, health of financial system. These 4 pillars are equally weighted, but the weight of each sub-pillar is determined on their materiality and the impact on the countries in terms of economic development and demography. They also apply different KPIs to address the sustainable development goals for each pillar. So they start with the JP Morgan Emerging Markets Bond Global Diversified Index. And as it's a best-in-class strategy, only at the end of June of this year, only 41 countries are included and 46 are excluded. So it's a relative value strategy. They perform with their own model of sovereign creditworthiness analysis based on different factors. It could be financials and also ESG. So it's a second round in terms of ESG, 23 factors. Then after that, they will look at the cross-country relative value opportunities. And then finally, they screen for relative value at the instrument level, cross-currency between the US, Euro, cross-issuer, sovereign versus quasi-sovereign, and cross-maturities. They also have a kind of top-down overlay to manage the portfolio duration and beta. As it's, you can slip to the last slide. As it's a best-in-class strategy, they exclude the worst country from the ESG point of view, and it's often the lower-rated countries. These countries are often the higher leading countries, and so in terms of performance, the strategy should perform well in risk-off environment and lagged in the index with a junk rally. When we have selected this strategy, the track record of this strategy was pretty short, and we think there is simply no substitute for a proven track record of experience. So when investment strategies are really short on one end, we require a proxy proven track record with an approach at least similar. So on this part, we have this their ESG approach, and the other part we have their view on how they manage the emerging market debt. So we do not select any investment strategy to manage our client asset without a proof of concept. And as it's our mandate, we can easily ask to the portfolio manager to create tailor-made solutions, exclusion of risk companies, countries. And in this case, we have asked to the manager to include more corporates and to limit the FX exposure.
Mm-hmm. Thank you. if you don't have anything to add with this, I think we get a lot of questions in the chat box, and then I will just ask some of them to you guys. So can I start with the first one? So I got a question, and it goes, how have you done the due diligence process during the COVID crisis? So Susanne, if you could shed some light on the due diligence part of the analysis, and how was this impacted? Was it heavily impacted?
Actually, I would say that we could follow our ordinary process, because the due diligence, depending on what part you're talking about, but I'm thinking about this heavy pack that you send out with a lot of questions and getting it back. I mean, then you have to set up the calls, and it's we have not had any new funds during this period, so onboarded, so it's only on existing funds, I have to add. So going forward, I have to also say, like Anders said before, if you do like white label, I totally agree that you do have to be on site, but if you take on external funds with their own labels, I would be able to take them on board even without the on-site visit, I would say.
Mm-hmm. Anders, so on your end, this how was this impacted, the due diligence section? Could you still manage to adhere to the process?
Yeah, so I totally agree with Susanne that for third-party fund research, we have done video conferencing, which has been long and painful. But for white labeling, we would go to extraordinary measures to get on site, because it is truly something different, and it requires more scrutiny and more certainty from our side. So we're really just we don't have any imminent white label funds up and running right now, or about to get up and running, which is sort of, so we're buying time and waiting, but numbers are going the wrong way right now, so it's not super optimistic, to be honest.
Oh, thank you. Another question that we got is that where should managers draw the line when it comes to sovereign EMD investments, given the multitude of ESG controversies in emerging markets, including, for example, Turkey, Saudi Arabia, China, Russia, Brazil, etc. So what should be excluded and what should be an engagement candidate? Arnaud, can you get a light on this?
Sorry, I was on mute. Yes, no problem. In terms of countries, yeah, for example, a lot of managers that we have saw on these thematics have excluded a lot of controversial countries, and you have, I think you said a lot of them. On this one, for example, it creates strong bias toward high quality, and they have excluded this controversial. Because I also forget to mention that they also exclude in their analysis the highly oppressive regime based on the Freedom House freedom and the high risk identified by the Financial Action Task Force. So it's exclude a lot of countries. And I forget the second part of the questions.
No, I think this was mainly it, and also just where should managers draw the line, you know, when it comes to sovereign EMD investments. So do you even have this excluding process?
Yeah, I think you should draw the line with the good one, and not exclude too much. I think, because if you exclude all of the universe, you have nothing. And you talk about only countries, but there is a lot of quasi-sovereign which can be also be excluded by this by their the ESG integration. So sometimes if the country can be included in the universe because it's they are really in favor of good practices in terms of for the sovereign one. Some quasi-sovereign failed this under their analysis. So it's something that we that we need to be careful. And in terms of engagement, I think it will depend on the size of the manager, because if it's a big one, they can have easily access to the central banks and some politicians to discuss and to engage, but it's really something that is not easy.
Mm-hmm. Thank you. I think this next question is very interesting. It's actually addressed to Anders and Arnaud, so either one of you can answer. So when you are developing ESG strategies, white labeling, essentially co-creating funds with managers, what is the best way to engage and propose ideas? This is the question. So is there any set up way of how do you guys start the process if you start working with a new manager?
For our end, we come with an idea, and then we don't claim to be experts within a specific field. So obviously, you know, when we talked high yield, we had some ideas that we shared with Aegon, who then came back and said, that's, you know, we follow your line of thought, but if you do that, you should be considerate of that. Then you might hit too big part of the universe that you would exclude, or it would get too skewed towards some extent and so forth. So you can have your ideas, but you also need to respect the asset class and sort of saying what is possible and what do you ultimately want to achieve, and then it is a back and forth conversation when you co-create, so to speak.
Yeah, I think when you co-create a strategy, it's really important, and we have this relation is to create a real partnership between the asset manager and us. We can give some guidelines, but we also need to hear what the manager said, if it's possible or not, because it's almost their strategy. And if we can create some tailor-made solutions, it's also important to don't modify the DNA of the company, which is really key.
Thank you. Susanne, I think we have a question for you. The question goes, I've heard a lot of warning to be cautious of greenwashing. What do you most look out for, such as maybe red flags, I think, to discern true ESG integration from greenwashing? So as you don't work with your own products, do you have anything that you specifically look out for to avoid greenwashing, or to red flags that you look out for within your team?
I would actually say that is where the qualitative part comes in, because I mean you can have nice slides and show a lot of figures and hands-on when you meet with the manager, and if the manager needs the ESG person to be in the meeting, so to speak, then maybe it's not in the DNA of the fund. So you really need it totally in the fund. So I mean, to be transparent with your figures and see what you measure and why, I think that is very important. So a lot of qualitative talk here, I would say.
Thank you. We have a question that's actually stated to all three of you, so anyone who feels can go ahead. So the question goes, how big is the ESG fund allocation in the total fund offering of Nordea, ABN AMRO, and Danske Bank? I would like to know if all their fund offering is ESG, or only, for example, 25% is ESG fund offering and 75% conventional, which would be like a classic way. So could you just share some light on how percentage-wise, what is the allocation of total ESG assets?
I don't have the percentage, to be honest. If you're a client in Nordea and has, you know, your savings here and you want a model portfolio, either discretionary or with advisory, you get asked whether sustainability is important for you. And if you say yes, then you get a model portfolio solely consisting of sustainability funds. So that is definitely something that we see growing. For the clients who says that's not important, they will get conventional portfolios. All Nordea products adhere to exclusion lists, which is determined by Nordea Asset Management. So in some categorizations, literally all Nordea products would fulfill some minimum threshold where there is at least an exclusion list. So the stuff with percentages, it's complicated, but we see definitely a growing proportion of the assets moving towards sustainable funds because of the discretionary and advisory setup model portfolios, basically.
And I could add to that and say that for Danske Bank, all the Danske Bank label funds, including the external managers, are sustainable, so to speak, have this integration. Coming to the external funds, that's, well, the work going forward. So in my mind, all the funds would have sort of a same bottom line, or so you have some kind of guidelines, and then you engage with the fund companies on top of that going forward.
And do you, all three of you, maybe Arnaud, you can give some insight on this. Do you see this percentage? I'm not sure if you know the percentage for ABN and AMRO. Do you see this as an ever-growing thing? And what we mentioned in the beginning, that at some point ESG is going to be the new normal. So people will not be okay to invest in certain non-ESG products. Do you see this happening?
For beginner, I'm sorry, I don't have the figures, but it's a growing area, because at the first, when a clients come on board, their first option is the sustainable portfolio. So it's really, if they ask to have another one, that we can have some more the old-fashioned way, I would say. But like Anders said, at ABN AMRO, we have a huge list of companies that are sent to our managers, and they can't invest in them. So it's created a kind of really low ESG profile. But for sustainable funds, for sure, it's a growing area for us, and it will be the new normal.
Thank you. We have many questions left, but I think we are running out of time. So I'm afraid that I have to thank everyone for joining, and I would like to thank all three of you for providing these presentations and for sharing your insights. Again, I think both on LinkedIn you can find them and ask them these questions, but thank you for providing insight on this such a relevant topic, ESG, and for doing your part in making investments more sustainable. So with that being said, thanks all three of you for joining, and I would like to thank our attendees for trusting RankiaPro and joining our conference call, and thanks everyone for joining, and I hope to see all of you in our conference call in October.
Thank you.
Thank you. Bye.
Thank you. Bye.
Bye.